Hello, everyone. My name is Sykes, and I'm a portfolio manager with Gabelli Funds, and I am delighted to be here with Jacob McDonough, and we're going to be talking about his new book, Capital Allocation, which just came out about a year ago, and it focuses on Berkshire Hathaway. We're going to be talking about the book as well as the Berkshire Hathaway component and the upcoming meeting in a few weeks. So it's my pleasure to introduce Jacob McDonough. Maybe you could just talk a little bit about your background and how you first got involved with following Berkshire Hathaway.
Yeah, well, thank you for having me. I'm Jacob McDonough, and I live in Grand Rapids, Michigan, with my wife and two young daughters. I'm an investor. I manage capital for outside clients right now in an RIA structure. And I started following Berkshire because I love compound interest. Compound interest is fascinating, and there's very few real life examples that are like Warren Buffett's life or Berkshire Hathaway. There's very few real life examples of very long-term compounding. And if you look at Warren Buffett's life from maybe 6 years old, he started making money, and now he's in his 90s. Hopefully it'll go past 100 years for him in compounding and just making money, saving money, reinvesting it, making more profits, reinvesting those. A lot of times people retire or want to go spend their money. So there's very few real life examples of such long-term compounding, and most businesses fail. Capitalism is brutal, and so there's not that many companies with very long track records, and even fewer companies that retain all their earnings through most of their history and keep compounding. So it's just a fascinating example to study the effect of compound interest.
So Jacob, there's certainly been a lot of books written about Berkshire Hathaway, Warren Buffett, Charlie, of course, but you chose to focus on a specific time period and approach in your book around capital allocation, obviously the title. Maybe you could just talk about picking that theme for your research, and what was the impetus for writing a book in general? I mean, I know you appreciate the conglomerate, but what was kind of the catalyst for you getting excited to write a book? And then lastly, the support that you received from Omaha. Talk a little bit about the reaction there and the help.
Yeah, so the time period I'm most fascinated with is the time period my book covers, which is 10 years before Buffett took over. And then it ends in 1985 when the original textile mill closed down. And so what fascinates me the most is Berkshire is one of the most valuable companies in the world today. So one of the most valuable companies in the history of the world. And it really, you can trace their history back to three failed businesses: the original textile mill that Berkshire Hathaway was, blue chip stamps, and Hochschild Cone, which they bought through a entity called Diversified Retailing. Diversified and Blue Chip merged into Berkshire later on. And so the time period my book ends, 1985, all three of those businesses were basically extinct, basically worthless, the original businesses. And so I'm a practitioner. My dream job is to allocate capital at a company someday. And so I imagine myself in Buffett's shoes in 1965 with all of his net worth in three businesses. And if someone told me in 20 years, all three of those businesses, your whole net worth is tied up on, is going to be worthless, that's a scary thought to me. And maybe my first reaction would be, how do I get my money back? How do I even salvage value here? And obviously, not only did Buffett salvage his investment, he made it one of the most valuable companies in the history of the world. So just going back, trying to put myself in his shoes in 1965 and see what could have an investor seen in the financial statements, annual reports, and then what did that transition look like over the next 20 years when looking at annual reports and financial statements. It's the most fascinating aspect to me. And as a reader, I read everything I could on Buffett and Berkshire, and I came away wanting more financial detail. And so I had to track down the old annual reports, financial statements for Berkshire, the companies they invested in. And it took a lot of time. So I figured other people might enjoy reading, what I put together that might not have enough time to hunt down the annual reports and stuff. And little did I know, Adam Mead wrote a great book. So at the same time, when I was writing mine, he was tracking down annual reports, and he made those available to investors. So I sure wish his book was available when I was trying to track down the stuff, but he did a great job too. And it's nice to try to relive the glory days of Buffett and Munger.
That's great. Yeah, we have a great appreciation for Adam and his work as well. So in the book, you talk about a few of the case studies and the companies And I think what's kind of timely today is to go back and look at the example of the acquisition of one of the banks back then. And you discussed some of the dynamics associated with that bank. And maybe you could just give us a little history of what happened during that time, and how that compares to how the banks are run today, the competitive positions, and also some of the dynamics that the banks today are also facing. So perhaps around
Yeah, that's,
conservatism, yeah,
yeah,
conservatism of their balance sheet, cost management, et cetera, all these things that you highlight.
yeah, that's a great example to talk about. So, uh, one of the early investments acquisitions that Berkshire made once Buffett took over was the Illinois National Bank of Rockford, Illinois. And so, um, yeah, there's two very unique aspects to that acquisition, to that business. So, number one, they were very efficient and very low cost. And number two, they're very conservative. So, maybe just first talking about how they were low cost. The state of Illinois had very unique banking laws back then. You could only have a bank like Rockford, the Rockford Bank could only have one branch location. So that really limits your growth potential. That's okay though for a company like Berkshire where it can take the profits of that bank and put them into other businesses. That's okay. But um, it's very unique. So there was one branch location, but the bank had incredible economies of scale. Now you wouldn't think a one branch location could achieve that, but the level of deposits they had at one branch was incredible. I couldn't find anything that matched it back then as well as today. I mean, even like a Wells Fargo of today has lower deposits per branch than than the Rockford Bank had back then at one location. And now we have mobile banking, online banking. You'd think branch locations are less needed than back then. But when you think about economies of scale, if one branch location goes from 50 million of deposits to 100 million, you double your deposits. You're not doubling your branch locations. You probably don't need to double your employees or your equipment. So you really can achieve some economies of scale even at one location, which basically means you're leveraging more work per employee. Um, and so that's what the Rockford Bank did. They were run very efficiently, had economies of scale, so they're very low cost. And now, what you could do, being low cost, is you could kind of take those low costs, those operations, and either be incredibly profitable, or you could be channeled the second approach. They took the conservative approach. So what I mean by that is, in that they had very high liquidity, and they had a lot of cash on the balance sheet, and they had a lot of short-term government bonds that matured in less than a year. And then finally, they also had loans. And so a lot of banks would not be able to earn attractive returns on capital if they had a lot of cash sitting around and if they had a lot of short-term government bonds. But this bank was able to earn good returns, like very good returns for Berkshire, because of those low-cost operations. They are still able to be very conservative, um, and and still earn an attractive return. And so it could have been higher if they wanted to leverage more, if they wanted to, go more all in on loans instead of keeping liquidity around. But that's not the route Buffett went. So just to give you some perspective, the cash they had plus the government bonds that would mature in less than a year exceeded the level of demand deposits they had at the bank. So basically the checking accounts and accounts that people could withdraw at any time. So there was never going to be a bank run at Rockford, but if there was, they had enough liquidity basically where they could fund everything right away. So number one, they weren't taking risks in liquidity, and then they weren't taking interest rate risk because they had very short-term bonds. They could probably earn more interest income if they had longer-term bonds, but they didn't take that route. And then their loans had very low charge-offs, so they made good loans. And so if you have low-cost operations and you're not taking too much risk, it's going to be a good result for Berkshire.
Amazing. I think that probably comes out in his Bank of America investment today, which is pretty significant, obviously.
Yeah,
So
exactly.
switching to a sweeter subject, See's Candies. You highlight that as another case study in the book. You can certainly appreciate the product, but what what made this a very attractive business for them to acquire? And you highlight some specific metrics and fundamentally about the business. Maybe you could just go over that for our audience. And then if you could talk about kind of the return on capital that was impressive there, and why it was obfuscated to some extent by the significant cash flow generation.
Yeah, so See's Candy is a great example, and there's a lot of others that they acquired at the time or invested in where the company was very overcapitalized. They had a lot of cash on the balance sheet and very little opportunities to reinvest that cash. Um, Similar to the Rockford Bank, that's a great example for where Berkshire could, acquire the company, and if they need to, they can take that cash elsewhere. Um, and so there's a lot of examples of that, and See's was one where um, there was in Moody's manuals, there's data on Seas going back decades before Berkshire acquired them. And so I was going through the Moody's manuals and libraries and just looking at Seas over time. And in the decade leading up to Berkshire's acquisition, there was times where more than half of the asset value on the balance sheet was cash. 40 to 50% of the assets on the balance sheet were cash. So a lot of times return on assets was very high for Seas, and you would think for a non-financial company, no one really talks about return on assets, but for banks they do. But for Seas, return on assets in some years before the acquisition was say 12%. Return on equity was only maybe 14%, right around the similar to return on assets because there's very little leverage. But they also had, like I said, so much cash on the balance sheet that if that cash could be redeployed elsewhere, the return on equity, return on capital would be more like 30, 40% or higher. And so just from Berkshire being able to take over the company, allocate capital a little better, returns on capital could be much higher. And yet there was still the safety of Berkshire was retaining the capital. So if See's Candy went through tough times, they weren't paying out that capital as a dividend or leveraging up the business. The overall Berkshire parent company was still had that capital that the company could fall back on, and they had diverse earning streams. So it's still a way where they could be maybe more aggressive with See's capital, but not really take any too much more risk.
Okay. We all assume that Warren has an exceptional track record, doesn't make any mistakes, but in your book, we do see some history with challenges. Maybe you could just talk about one of those and what was learned from that kind of case history in that firm.
Yeah, there were tough times and mistakes. And one thing I really like seeing is there's just so many examples of Berkshire being opportunistic and pivoting and not being afraid to change course when they need to. There's multiple examples of that, but one of my favorites is the Diversified Retailing Company, which Munger, Buffett, and Sandy Gottesman formed. And so first it was a separate company, but it eventually merged into Berkshire during the time period my book covers. And so they formed the company to acquire a bunch of retailers. And so the first retailer they acquired was Hochschild Kohn, a Baltimore department store. Then they acquired Associated Cotton Shops, I believe it's called. And within a year or two, they sold Hochschild Kohn because they realized it was a mistake. And so they used the proceeds to buy Berkshire stock and blue chip stock. And so over time, this was a very successful company, but it was not diversified and it was not much of a retailer. It owned two stocks basically and one retailer. And they set out with their master plan of trying to acquire a big group of retailers, and eventually they realized they made a mistake and pivoted out of there. So I love that. And over time, you can see they went into Wesco Financial, the savings and loan business, and pretty quick pivoted out of that business and used the capital to get into other things. So there's a lot of examples of them staying nimble, opportunistic, and not being afraid to change course even when they lay out a plan ahead of time.
Great. Interesting. So your book provides a great history, certainly the early evolution of Berkshire Hathaway and how it kind of got to where it is today in terms of pathway. Maybe you could just talk about this evolution today, given your research, in terms of what is an outstanding characteristic of the conglomerate from all of these acquisitions and execution of capital allocation. What's an outstanding characteristic that you think deserves to be talked about and is perhaps underappreciated by investors?
Mm-hmm. Yeah, there's so much that's changed over the years. Um, and one big change is the way they can use float. They're so big now that they when my book ends in 1985, they couldn't really do as much as they can today with the float. Now today they can do just about anything they want due to their size. That's one major way they've changed. But maybe a characteristic about the organization is maybe their capacity to suffer. So they're able to take short term pain to benefit in the long term. So in that Rockford Bank example, they easily could have increased earnings in one given year if they held less cash and made more loans, or took on invested in 10-year bonds instead of just bonds that matured in less than a year. Um, but then eventually, they might run into trouble if they're more aggressive like that. So there's plenty of examples like that where they take the long-term view. And in my book, I cover a few periods where insurance premiums dropped in a major way, maybe by 80% or so. And so um, to be a great insurance company over many decades, or if you're trying to be a company that survives centuries, you have to be ready for bad times that are bound to come. And so an insurance company needs to prove that they're willing to have years where sales go way down. If there's not profitable insurance to be had, if you can't make profitable sales, then you really should say no to the sales and let revenues decline. And there's definitely periods in my book where I cover that they prove they're willing to do that. And so they've proven time and time again that they're not only willing to be conservative, but they're willing to make the short term look worse than it really could be in order to benefit the long term.
Fascinating. Okay, so in a couple of weeks, we're all heading out to Omaha for the annual meeting. This will be the 2023 meeting, and we've had an interesting year in the markets, and certainly from capital allocation. Uh, Maybe you could just talk about what you expect or would like to hear, or a focus that might come out of the Q&A this year.
Yeah, interest rates, I'm sure, are on everyone's mind. So I think they'll talk about that. That'd be great to hear a little bit. And it's interesting how it affects Berkshire because they have so much float. Higher rates could mean higher interest income on the fixed income side of the float they have on their balance sheet. But so that definitely could obviously would help profits. But on the other hand, in terms of competitiveness with other insurance companies, Berkshire stands alone on what they can do with their float. And that really proves itself in the low interest rate environment where, if a fixed income portfolio is not paying you much, their insurance competitors don't have too many attractive options. But Berkshire did in terms of, they can do other things besides have fixed income. So although it helps on an overall basis, competitively relative to other insurance companies, the low interest rate environment does highlight some advantages of Berkshire's system. But still, the way interest rates affect Berkshire is going to be interesting, and would love to talk about. Love to hear Buffett and Munger talk about. They also have very unique ways to discuss the banking industry, and so I'm sure they'll have some commentary on what's happened in the first quarter here. But it will be a lot of fun to go listen to them again.
And given the success of your book and the appreciation, I believe, by Warren, you were one of a few that have been selected to be a part of the book list that's been noted, and have your book publicly available at the conference or at the AGM. And so I think that's a true accolade to the work you've done. And maybe you could just talk a little bit, about your schedule when you're going to be out there, and what, who you hope to see, and where your availability in terms of demonstrating your book or showing off your book.
Yeah, thank you. And so, yeah, I'll be at the Bookworm in the arena on Friday and Saturday. Last year, the Bookworm was right next to the Seas Candy area. So when you are getting your peanut brittle, be sure to stop by and say hi at the Bookworm. I'll be selling the book there and signing copies Friday and Saturday, all day in the arena. And then my book's gonna be for sale in the airport too. So Sunday, as people are flying out, I was gonna go by the airport as well. So I'd love for people to stop by, say hello, and grab a book.
Great, Jacob. Thanks so much for the time today, and congratulations on all the hard work. And we look forward to more insights, certainly from you going forward.
Thanks for having me.